My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Anthony Crudele. I'm excited for this conversation with Anthony. I think this will be a really good back and forth about not just the current market environment, but what it takes to be successful as a trader from a longer term perspective. Anthony, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in trading and markets? And what are you doing now?
Where do I begin with this one, Michael? First of all, thank you so much for joining me. And for those of you on this holiday weekend joining us, good to have all of you guys here. And I look forward to this conversation as well. How I got into trading, it's a long story. I'm not going to go into the whole details, kind of how it started. But I actually got into the business by accident at 18 years old. I took a job out of the classified ads in the newspaper. Does that still even exist, Michael? I don't know. Can you go to the newspaper?
You got me wondering there.
And I took a job as a runner on the floor of the Chicago Mercantile Exchange at Lynn Waldock. And I never left, never ended up going to college or anything. It was something I started right out of high school. And then quickly it just became just part of me, and I just loved it. I mean, if anyone has ever been on a trading floor, specifically the Chicago Mercantile Exchange, the first pits I ever walked into was the S&P 500 pit, the live cattle pit that was all on the main floor. And I just said, this is unbelievable. Why would I ever want to go anywhere else? And then fast forward, I became one of the youngest members of the Chicago Mercantile Exchange. And then I went through membership when I was 20 years old. And I had to wait till I was 21 to become a member. And I had to wait for months to even get a seat because there was no seats available. And I started trading the E-mini S&P 500 pretty much right in its inception in the late 90s. Some of you may have heard of the E-mini S&P 500's electronic version of the S&P 500. And that came into play. And because I was a younger, newer trader, and I really didn't have enough brokers to trade with me in the S&P pits, so I actually took a leap of faith and started trying to trade electronically when it was just starting. And wow, that was an interesting time. And I never left it. And then and the years goes by. Some crazy things happened to me in my life. I had a heart attack at the age of 36 at my trading screens. And that was 9 years ago. And then I started actually a podcast called Futures Radio Show. I was doing CNBC and Fox Business a little bit at that time. And I just felt that they weren't really doing a true service to the futures industry. And that's what my background is. So I started a podcast called Futures Radio Show. And really a lot has happened since then. But in a nutshell, that's who I am and my background.
So you and I share a little bit of a common experience there. You mentioned being a runner on the CME. So when I was 16, I had interned at the floor of the New York Stock Exchange. And how far we've come, right, in terms of just the energy level, the activity. I'm sure it's similar to the CME. You'd be walking around, you'd see all kinds of, trade order tickets, slips on the floor, and it was just a sense of chaos. Do you think that we've lost sort of the excitement around trading because it's not as physical? And I mean physical in the sense of what you used to see at these exchanges when it actually was populated with people instead of studios.
Well, I would say that if you look at most of the pit traders, the people on the floor, and why they struggled to move electronically is I think exactly what you just said, the physical aspect of it, because you're sitting there with all of this access at your fingertips, and it's so easy to overtrade. It's so easy to dip into every market. You don't have to make an actual physical movement to do it. And I think that is created such a challenge, I think, for newer traders. We all wanted more access. We all asked for it. We all wanted it, right? I want to be able to trade this stock. We want everything to be open. Why do I have to go to a trading floor? But then lo and behold, what happens is you create a lot of unexperienced people that start and they end up getting involved in something that they really have no idea about. They don't understand the language. They don't understand. And when I say language, it's just the understanding of markets, just the talk. Like you and I probably are going to say some things today that we take for granted because of our experience, but some people may not understand what we're saying. And, for you and I, we had to go through actual, different levels of learning to eventually be able to be in a position to trade. It wasn't just like I could walk on the floor and start trading. You had to actually earn that. And I think that created obviously massive amounts of opportunity, but I think it created also the wrong way for people to get into markets, because there's just too much access and they don't have to go through any loopholes like I did. I had to take a test to become a clerk. I had to pass a bunch of stuff to become a member. And then I had to go into a pit and actually physically voice my opinion with a bid or an offer. And it's a lot harder to do that unless you have really confidence in what you're doing versus clicking a button on a screen. It's so easy to do that. And I think that is the one thing that I feel is really lost in today's industry. Is like, I think you nailed it. It's just the physical aspect of it. I think it was extremely important to spend time around people that did this first versus just opening up an account and trading the next day. It's funny, Michael, people are pissed about some of these account processes that take like 2 to 3 days to even open an account. They want to be trading that day. And you think about it, and it's like, listen, man, I had to wait for months before I could even get my account going and all this stuff. It was just a totally different thing. And it created patience then, which I think nobody has. A lot of people coming into this now just don't have that same level of patience because of that.
Yeah, and I have to say, I'm always torn on the idea of democratizing investing, because you want to get broad participation, but you also don't want necessarily the reckless gamblers and speculators. And I understand somebody will say, well, listen, I mean, there are plenty of hedge fund managers that are like that too. No disagreements, right? But I do feel like there has to be a cost of entry. And I've often ranted on this point, Anthony, that I think the worst thing that's happened to investors is commission-free trading. And you kind of alluded to the reason why when you use the term overtrading. Not only is it now allowing people who don't know anything about investing, about risk management, about cycles to enter and maybe make money and get lucky, but it also causes them to do all the wrong things because they end up selling or buying because they feel that they can always get in or out because there's no friction to doing that.
Exactly. There's no levels of discipline put in place before they even begin. I think that's kind of what we're saying, right? There's no level of patience installed in them to come in. It's just like, come in and start clicking buttons. And that's just what the industry pushes now. And, it's, and the way that these markets are moving, it's just the wrong way to approach it. Everyone talks about being patient, being disciplined, but unless you are really mentally in a great place and you come into trading or investing, you're going to make all these mistakes. I don't care what anyone tells you. You can read every book, you can listen to every podcast and everything out there. But at the end of the day, until you actually go in there and make those mistakes, it's just going to be, you're never going to learn from it. And the easier we make it and the cheaper we make it, which, like I said, for professionals, people that have been doing it, it's great, right? But for these newer people that we don't hold on to them for too long. I mean, the churn rate has got to be, really high with people that come in and out of this business. And it's because of these, like I said, there's just no disciplines being installed in them before they come in. I've never been someone who felt that any sort of cost of trading in terms of fees was going to enable, not allow me to make money, because at the end of the day, I never, if I was spending a ton of money on commissions or exchange fees, it was just because I was over trading. And then when I start, when you learn how to just deal with it and you're like, listen, do I really want to do this? And now I go back to what you said, the commission-free trading and stocks. It's not like that in futures, but it just, like I said, it just allows people just to come in and click buttons. And there's a lot of good to that too. I don't want to really be negative on it, but I just think that for the initial person, and I just go back to it, doesn't instill any disciplines in them.
Yeah, and I think the other thing is that you allude to the word mistakes. I mean, I'd argue that if the longer you're in the business, the easier it is to really understand what a mistake is. And I say that because I think a lot of newer traders think a mistake is when they have a loss. I always have a big issue with that. I keep using that line multiple times, right? Amateurs look to the right of the equal sign, pros look to the left. Because this is a game of probabilities, which means you have to roll the die multiple times, you can be wrong in the small sample of the here and now of today, right? That doesn't mean that the process that got you to roll that die was wrong. It's just in that single roll of the die, it wasn't right.
I love that line that you said on the left-hand side of the equal side versus the right-hand side. It's so interesting. I never heard that before, and I totally agree with you on that. It's not about the mistake of the loser. It's about, when did I step in? Why did I step in and do this? I mean, look at these FOMC days. Look at these CPI days. And, people probably just stepping in and just without any reason, right? I mean, that to me is like a mistake. Like, why are you doing this right now? You're just stepping in because you want to be part of the action, and because it's busy and it's enticing. That to me is what I would consider a mistake on a new person's part, about not knowing exactly what they're looking for, or following somebody's blind advice of like, oh, this is a good level here, and stepping in, and you have no thought behind it, you have no reason, you don't know where you're wrong, you're just getting in. But yeah, no, I agree with what you're saying on that. I think that when you go back to, I think the discipline side of it, things to me, when I look at the newer traders, and I think, like we said, the ease of access is that I think that I want people to understand that you need to really come in and have that, the I don't know if we call it a buffer or something that just kind of slows you down into it, because I go back to my days of walking into the trading floor and like actually having to spend time watching and viewing markets. Like I wasn't allowed to have the access to it, so there was actually like space between like a clerk and like a member who's trading, and that allowed me to watch from a place where I knew that I wanted to do it, but I was allowing myself to watch and learn what other people were doing. And I think that to me is the number one missing element in just today's world, is just the ability to sit down, take time, watch, and learn without having, that access, or, because you're obviously going to have to be disciplined enough to not push the button when you have it, but to just slow things down around you. Because the success that I finally found, even as a trader, even with me having that buffer, that time to finally get into the markets, of course I was in a big hurry to make money right away. And what ultimately happened, I blew a bunch of money at the beginning of my career. And until I was able to really slow things down around me and be like, look, you don't have to do something unless you really want to, unless I'm forced to do something. And that's, to me, when you actually learn how to become a trader.
Yeah, no, I agree. And the other thing, of course, as you know, is it's also kind of a function of when you start that trading journey, right? Because if you started, towards the March lows, like a lot of retail did, right? A lot of investors did, traders did. You get very overconfident, and then, suddenly the market, like it always does, humbles you. To pros and amateurs, I wonder if you think this year there's another maybe dynamic at play, which is to say that people that have entered this year bearish, if they have maybe become too seduced by the sequence of the returns. I've made this point before that you've never had a period in history, except for one time in 1931, where the number of weeks the S&P has lost money is this high. 63% of the year, stocks have been red using weekly data, which has really given a lot of firepower to traders that are short, right? Because there's almost been a degree of consistency. How do you think about new traders entering in a year like this year, which, just like 2020 to early 2021, I'd argue is abnormal, just the other way around?
It is so interesting on when you start your career as a trader, right? I mean, I started in the mid to late 90s, and everything was just learn how to be a buyer, right? Everything grinded higher. And then when 2000 came, it was just changed everything, right? I mean, in March of 2000, all of a sudden we're having limit down days every day, and you're in your mind, you're still looking for places to buy when the trend has just changed right in front of you. But it's hard for you to recognize it, because you learned something, you learned a way to make money, and now that really has changed. And in the moment, you're not really recognizing it. Look, I know a lot of people that started in '07 or '08, and look at how different of a time that was. And just, you can go back to every really significant point in market history, and it depends on when you start, and how that kind of determines the way that you approach your strategy and you approach your trading. I mean, obviously the 2020, with the COVID, people that came in, I mean, they experienced gains like, it was just crazy. I mean, it was almost like a time where it was like that David Portnoy time, right? Where it's just like, buy something and it was going to go up. And I knew so many people that were actually a lot newer traders than me, that were making more money than me by just blindly buying stuff. And I'm laughing and I'm like, well, maybe I should be listening to what they're saying right now, and then all of a sudden, then you get into a scenario like this where it's just teaching you everything the opposite. Now you get in aggressive and being short. And I think the moral of it is that, and I've said this a bunch on Twitter, is that everything works sometimes, nothing works all the time. And what happens when you come into a market, the market trains you in a way that, like, something will work and work and work and work. And then you're like, okay. And then you start to embrace it. And then all of a sudden it changes the tune a little bit. One of the hardest things for myself, and I think for every trader, is recognizing when that song has changed, when that tune has changed. And how do you do that as a new trader? Well, the reality is you're never going to know. You're only going to know so far into it that all of a sudden it's changed. And I think that, the way that markets change environments as quickly as they do, I think it's going to be difficult for every single level of trader. And the only thing I could say to the newer traders out there that have come in and learned based upon the environment of when they first started is that just know in the back of your mind that whatever you're doing right now is not going to work forever. And it's really, even in these types of markets, it's not going to work for very long. And I know I don't want to sound that in a negative or discouraging way, but the reality is that things change in these markets, unlike at the rate that I've never seen in my career. I remember, like I said, in the mid 90s all the way up, I would say until just after 2008, things were really this steady period of a similar type of market for many years in a row. And nowadays things change so dramatically. Even on a day by day basis, you have almost a completely different environment from one day to the next. And all I could tell you is, as a newer trader, is just accept the fact that what you've learned or what you're doing or what you've done to make money, it's take bits and pieces of it and allow the market. It goes back to like that time of learning patience. How do you know when to step in and not do something? And it's, the answer is, I don't know that. Even as an experienced trader, I don't know the exact moment of when something's changing. But the thing is, I allow it to change. And then I say, look, this is just not working. And I think that's the one difference, is that newer traders will continue to try and push something. All of a sudden they'll try to push that square peg through a round hole, even though before they had the round peg with the round hole, and now it's changed. They've got a different tool. It's a different environment, and you have to allow yourself to say, "Look, this is just not working." And I think that's the one difference between. I think it's a very important difference between retail, newer traders, and traders that have been doing this for a long time. Experienced traders is that we recognize when things are not working quicker, more in the moment, where it's like, look, I'm able to step away from this, because the pain that's going to follow if you try to force something that's not there. So I think the self-awareness thing is where I would say is allow things to be what they are, and understand that you're in a changing environment and you've got to exist through it, and just allow things to be what they are. I hope that made sense, Michael. The way it's a difficult question to answer.
Yeah, no, and I agree with a lot of what you're saying. I think that the challenge there is, I've used that line many times, right? Your ability to stick to a strategy matters more than the strategy itself. Now, when you're discretionary, you're retail, you're trading, you don't have a mandate or a prospectus which has to be followed, you can step away, right? We all know that. And you probably should step away when you're desynced. And I would argue the last thing you want to do is actually think about re-optimizing or rethinking your entire process, because the problem that I see a lot of people have is that they think that they can always tweak things and become profitable in the here and now, which presents with it an assumption that you're always going to have a strategy which is going to work no matter what environment you're in. And we all know that's not realistic. The challenge there is, how do you know when to come back in when you're in a dislocation, when you're desynced, right? Because it's kind of like the argument of cash. The problem with the idea of going into cash to step away from markets is that it's really two decisions. It's not just when you sell, it's also when you redeploy.
Yeah, it's such an important point. I agree exactly what you said in terms of, like, do you go back to the drawing board if all of a sudden your strategy is not working? And that's what most people will initially do, right? They'll go in and say, well, look, it's my strategy is not working anymore. Let me go back and change it. And you and I both agree on this. You said it a little differently than maybe I'm about to say it, is that, the strategy itself is not necessarily what's going to make you money. It's going to be the better executor of that strategy. My strategy has been very similar for the past 20 plus years. The little things that I change here and there is maybe I add a little confirmation tool with something non-technical. I always look at the macro environment and say, okay, how does my strategy work in this type of environment? And I just refine my execution of my strategy. So I look at what type of day or what type of market it is, and understand that, it goes back to what I had said just a few minutes ago. Everything works sometimes, nothing works all the time. And if you embrace that, it allows you to be in the moment to say, today is just not the day. Today it's just not working. The market responds. It's so funny. Like, we as traders, we believe that our homework and everything that we're doing, and anybody that we follow, we feel that their homework might be special, right? Somebody's numbers are more special than somebody else's. And when you really look at it, you could almost say that almost everybody has the same SPY numbers or the same S&P and NASDAQ numbers. They always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY numbers? And the one person who has the similar numbers, they always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY numbers? And the one person who has the similar numbers, they always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY numbers? And the one person who has the similar numbers, they always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY numbers? And the one person who has the similar numbers, they always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY numbers? And the one person who has the similar numbers, they always are very, very similar. And what's the difference between the one person who has the similar numbers and the one person who has the same SPY versus the other person. And it's just the way they execute it, right? It's the way that they identify the type of day it is, and it's the way that they go about and execute it. And I think that as newer traders, they rely so much on the strategy itself that they think that that strategy or whatever they're getting from someone else or whatever it is that's helping them make a trade decision is actually what is making them the money. When in reality, they're not recognizing the actual response that the market is giving to those numbers. For example, if I have an area that I really like and the market goes there and it just blows right through it and it shows no respect to my homework, right? And I've done that homework and I feel that that should be a good area. I like this area. Everything makes sense. Macro's telling me to do this. This is the environment. I want to step in and do it. And the market just goes, sorry, buddy. This is just not going to work here today. And as somebody who has seen this happen to myself many, many times, I realize that the market is just not respecting my areas. So why should I force it? When newer traders will hold on and lose more money than they should in an area because they're not looking at how the market is responding to what their homework is. They're trying to say to themselves, convince themselves that my strategy is what's important. The market, it doesn't matter. I'm just going to completely follow it blindly. And the one thing is that I've learned that you lose less in the times when stuff's just not working versus blowing up your account saying, well, I follow my process, I follow my strategy, but why am I getting just crushed? Well, it's because you're not recognizing position sizing should maybe be smaller now. Maybe, you're just doing less and you're less active in a certain environment. And that to me is where the skill set comes in. And that's where you have to have experience and see the different environments and understand that, I have to respect the way that the market looks at my information. And if it doesn't respect it, I have to be like, okay, you have to be okay with that. It didn't work today. But when it does respect it, that's when you stay in. That's when you're full position sized. And at least in my experience, that's when I've made my money is by doing that, is by watching the responses of the market to my strategy, not my strategy itself.
So let's talk about the current environment for a bit here. I've been pretty loud really since October 2nd up until really this kind of FTX stuff started taking place, that the sentiment was very dark. All the indicators that I'm known for were switching back to risk on. And there were a lot of silly, this is my view, silly narratives around why the path would continue the way that it continued. And, you've had a fairly sizable move, especially in small caps since then and higher beta names. Things look a little bit less clear, at least from my vantage point, when it comes to conditions favoring a continuation in whether it's a melt up or a bear market rally. To me, tomato. There's really no clear definition of melt up, right, to begin with. But people get so obsessed with this stuff. So I want to hear your thoughts on where we are in the very short term. One of the Twitter Space listeners, Arthur, sent me a DM wanting me to ask you about how you're thinking about various sectors here. Most look very overbought. Small caps, breadth starting to weaken. Give us an assessment of short, intermediate term from your vantage point.
So a couple things, and when you and I were talking about what are the things that I maybe want to discuss today, and we put it even in the title, we said don't be too bullish. And obviously we're talking about the stock market here, right? So the first thing I look at every single day is what is the dollar doing? Because the dollar right now to me is what's moving everything else. So I look at the technicals in the dollar first. You can pull up the DXY or whatever. That's what I look at. And I look to see where that is. If you go back and look at how they started to basically make a top, I think it was the end of September, and we've rotated down. And to me, that has, I felt that fueled a lot of this rally. Obviously, there's a lot of macro stuff going on where people think that maybe inflation isn't going to, or maybe is topped, right? And maybe we're getting closer to the Fed's target. But ultimately, from a technical standpoint and from a market standpoint, instead of looking at sectors or anything else, I look at what is driving the market, right? Because there's always some sort of story within the market in the price action that's moving everything else. And to me, that's the dollar. So dollar weakness has provided strength in equities. And so that's the first thing I look at. And when I look at the overall environment, and part of why I was saying don't be too bullish right now is, number one, is if you look at it from a technical standpoint, the 200-day moving average in the DXY is somewhere around 105 and change. I think we're around 106 is where we went on Friday. To me, we're at a critical point, which is so interesting because if you just look at, this is where I like to step back, pull up daily charts and say, look at the S&P. Where's that 200-day moving average? Where's the NASDAQ relative to it? Look and start looking at that and seeing if we're starting to see what I think, is just that overall picture. The 200-day in the S&P is not far from here. I think it's in the E-mini S&P futures. It's around 40.60. So I think we went out around 40.30 on Friday. So when you look at that, you're saying, okay, we're almost there. And then you also look at where the dollar is to the downside. So what happens is you have the opposite correlation markets hitting technicals at the same time. So which tells me we're obviously at a very key moment, right? And we're at this moment where if the dollar were to continue to go lower, I think that you could see stocks, specifically talking about S&P, start to go higher. And I think when you look at, going back to the question you asked about, internals with the different sectors, I think I don't really follow the sectors as much as I will as the major indices because that's what I trade. But if that starts to happen, I think it just becomes a tidal wave and it pulls everything higher, or it starts to pull everything back down, depending on what happens here. But I actually do think we're at a critical time, and why I don't think we blow through to the upside and in the S&P and to the dollar and to the downside is, Michael, you and I have both traded bear markets in the past. How many bear markets have you seen turn around massively the last month of the year? Now, I don't have this exact stat, but in your experience, do you remember?
Yeah, not many. No, clearly, sure, yeah.
Right. So in my mind, I always look at it like this. Right now you have the seasonality, and I see a lot of people really getting very bullish. And you have a psychological aspect playing a role in the marketplace right now too, right? You've got a year where a lot of traders have gotten beat up that are mostly playing alongside and playing stocks. And so now you have this FOMO coming in. Well, have we bottomed? Right. And you have a lot of people stepping into a bear market with the Fed still raising rates. Let's face it. I mean, rates have come down, no doubt, but they're not going to start cutting rates anytime soon. Some people may disagree with me on that, but I don't think you're going to see that for a while. I think that you're going to see these rates stay here for a period of time. And then I think that, like I said, you have this big bull market in the dollar, you have this big bear market, and everyone is looking at it, and all of a sudden they're maybe trying to catch something. Then going back to you kind of said earlier is that, look at when we were near the lows and certain things were turning, that made sense. Right now you have the masses coming in and saying, well, maybe this is over. And I feel like that's where it gets crowded towards the end of the year. You feel like, oh, all of a sudden, like maybe things have changed, when I really think, even with some of the data, and I'm not a macro expert, is still just telling us that maybe things are not going to be as aggressive on the Fed side, but ultimately the environment is truly not changed all that much. It's just a mean reversion type move. And so I look at it like this, is that this is where you start to get this trap, and where you come in and all of a sudden, look at even myself, look, I've been in cash in my stocks. I'm not a stock trader. I'm a stock investor. And I'm looking at it going, do I start buying them here right now? It's so funny. I'm sitting there saying this to you guys, and I'm thinking to myself, do I want to start adding to my portfolio now? And I'm looking at it going, you're going to buy a 500-point rally in the S&P now when rates are still going up, the Fed's still going to raise, and I don't think much has changed, right? And I know that there's a lot of other people thinking that same type of thing. And then when I start to think about it, I look at the environment and say, Anthony, what's happened this year? Just because this little bit of data and some of these things, we've finally gotten the pullback that everyone was calling for months and months ago. And now all of a sudden, do you want to stay that does this have sustainability? Now, I don't have the answer to whether it has sustainability, but I look at overall simple things. The 200-day moving averages are important because what's going to happen is, whether you believe in these moving averages or not, I really don't care. For me, I'm not going to make any trades off of the 200-day moving average, but it gives me the perspective. And then you have all of the trend players that are going to start to come in. So if you start to see this dollar weakness accelerate, and maybe there will be some headlines and some things that start to say, look at things are truly getting better, and you have technicals coinciding with some more headlines, then maybe I think stocks can be a play to the upside. And I still think it would be met immediately with some resistance. But I think that ultimately what we're seeing is a mean reversion type move. I think it's a trap going into the end of the year to be too bullish, because going back to that thing I just said, I've seen many bear markets. I don't ever remember any of them coming back at the end of the year. They always end up kind of turning around in Q1 or to middle to end of Q1. And I'm not predicting that's what will happen, but I've seen that happen before. So I lean more towards that's probably when we start to see stocks become a true buy. I don't love this environment right here. I think it's a mean reversion back to a key area. And I just think that the seasonality is playing in. I think it's kicking in with some other things that are giving it a little bit more juice than maybe it would get otherwise.
So a couple of things that come to mind as you talk through that, Anthony. So on moving averages, I've made that point before. I don't view the moving average as an indicator of trend. I view it as an indicator of volatility. And I say that because that relates to the 2016 Dow Award paper, Leverage for the Long Run, that I published. And the finding there is that you tend to have a lower volatility when you're above a moving average. You tend to have higher volatility when you're below moving average, more streaks in terms of consecutive up days above moving average, more big whipsaws below. So I agree on the 200-day. I think it becomes challenging because it might suggest that volatility could, again, surge higher. The dollar is the question mark. I've been tweeting repeatedly, using the whether it's Backstreet Boys or NSYNC, bye Giphy, right? But as the dollar was topping out, saying it looks like distribution. But it is interesting because if the dollar, I think to your point, if suddenly the dollar were to make a comeback, that would be a big warning sign, especially if it happens alongside Treasury strengthening, meaning long duration yields falling, which would be more classic risk off behavior. And I've been noting that Treasuries are acting more like their historical status as a safe haven, a flight to safety trade, when the bulk of the year it's been hell, in my world, because they completely failed at doing so for the first time in history. You remember 2018, right, when you had a pretty big sell-off, the Christmas Eve massacre, right, in December.
Yeah.
Do you think there's a possibility that we see a bit of a repeat? Because I think that I don't think is too far outside the realm of scenarios where you could have suddenly just a real dump at the end of the year, just as everybody's optimistic that maybe the bear market could be over.
It's funny you say that. I in my mind, a lot of what I'll look at in my trading is not just strategically what I look at on a chart. It's envisioning what I think the moves could be, remembering what has happened in the past, and just looking at this current environment and going, what has happened before that you remember, and going back to, like you said, 2018 and just different times in my career where I look at these bear markets and I just remember thinking to myself, more of where I put my investor hat on. It's like all of a sudden you start to see these rallies and you're like, hey, do I want to start buying some stock again, right? You just feel that way. You can't help it. Doesn't matter how long I've done this, all of a sudden you feel like I just want to step back in. And to me, I feel like it's that same type of feeling this year. So I do think that that's very possible, because what happens is people think that this, obviously price always changes the sentiment, right? And it just, that's the way it is. And so when you start to see price action start to come back up, you start to see people step back in. And I love how you talked about the 200-day moving average for lower the volatility and all, and I do agree with that entirely. You start to see these things peak up where we get to these key areas, and very few people start to talk about selling them. A lot of people talk about buying into them and looking for this end of this bear market to happen. And I think that is why psychologically it sets up for something potentially to happen like an end of the year sell-off, because of the fact it creates you to be more comfortable. And I think that longs get more comfortable with it. And so now pullbacks are like, hey, I bought it, I'm in, maybe I want to be in. I like this area now. I think the lows are in, and the squeezes just happen from those levels of comfort. And I'm definitely more of a short-term trader. And any stocks that I would be buying, I would be holding them anyway, because I would be buying them for my longer-term portfolio unless they just got totally wrecked. I would obviously have some stop involved in there, but I trade more of the indexes on the short term and stocks for the long term, which I own not one single stock right now. And I think about that, and so that plays a role into this, because it's not just technical. It's about when it's when the technicals are showing us this. And I think that's why I think it's very, very possible that a scenario like that happens. And that's why I said, be careful being too bullish here, because this is where these times all of a sudden set up. So to answer the question, do I think that December, like that type of scenario could happen? I really do feel that that's very likely.
Yeah, and I would know that, as I mentioned on Friday, I mean, it's Credit Suisse hitting new lows, and I know there's all kinds of rumors and this, things going on around, maybe a takeover or not, but that's not exactly healthy action, especially when the seasonality is still favorable.
In my experience, and what has helped me as a trader the most is what I'm about to talk about. And that is know when to be big, small, or not at all. And that has nothing to do with a price level that I have. It has to do with the reaction to the price level that I have. So for example, coming into this week, I will be looking for short scenarios. Why? Because of all the reasons I just said. I think that the dollar, we'll see how it does at the 200-day moving average. Unbelievable how it's happening at almost the same time the S&P is hitting it for resistance. The dollar is hitting it for support. I will watch that closely. I will put my levels of support and resistance and know that, look, at this could be a time where we start to revert back within primary trend. So first of all, I look at what is primary trend. Primary trend is down. Short-term trend is up. So my first thing I think about is, okay, it may seem like I'm fading this rally, when in reality this is the opportunity to go back with primary trend. So even as a day trader, I look at it and say, the primary trend is down for the year. That is the side I want to be on. So when I get something where I have a lot of confirmation, I will look to step in. If the market responds to my price, I will get in aggressively. And how I do that is this. I look at everything in scales. So for example, let's just say hypothetically, 40.60 is roughly the 200-day moving average in the S&P is what I have futures-wise. I were to have a level at 40.60, just to make it simple. It goes up there. I will probably start to get short 25 to 30% of my position. I like to really do everything in quarters or thirds. And if I see that holds and there's an immediate reaction, a reaction in price, a reaction in volume, right? Because that's important. Will the reaction come together with price and volume off of that area? Bam, I will step in very aggressive very quickly and get to 100% short. And the reason why I would do that is because I have all these other reasons behind me. Primary trend, 200-day moving average, my price level is there, and now the market responded to it. So I would step in after that 25 to 30+%, and if I saw it respond, bang, I'll hit them harder, and now I'll have my stop relatively tight, and I'll trade a very large contract size because I will keep my stop very tight because the reaction's already occurred. See, most people will try to get in before the reaction occurs. I would never be 100% short in front of the 200-day moving average. Let's face it, this S&P could go to 4,100, 4,150. I mean, anything could happen, and then still close the day below the 200-day moving average, and that would be the true test, right? It's not about just hitting the 200-day moving average and stopping on it and coming off. When you're testing a major level like this, you have to watch multiple days and see how the action is. So it's not like, oh, well, it's trading 40.61. There you go, Anthony. We're going to rally now. So I intraday or even multi-day, however way you would trade it, I would watch it and wait for the reaction to start to set in. So if it's just grinding through an area, anytime we slow grind through any price action area that I have, I am only in small because I'm getting grinded against, right? So it's the action is going against my thought, my idea. And so that's why I like to scale. And once it responds, that's when you do it. So the key is not to be in a hurry, to be in right away. The key is to be in after the reaction occurs, because that's when the true follow through will come. How many of you out there have bought or sold something that you felt was at a really good place, but they just grinded you out for a little bit, and eventually it finally went your way, and there's a reaction where you're going, oh, God, I could finally get out of it. Well, that's when I'm getting in more. Because in the past, that's how I would trade it. Get in and go, oh, please go my way, right? And you'd hope for that good reaction. But I said, wait for the reaction, man. What's your big hurry? Slow down. Then I hit them. That's how I trade it.
I'm glad you hit this because this is everything wrong with FinTwit is missing this point. So you'll end up having all these people talking about and showing some chart and showing how they made some big trade on some particular ticker, but nobody ever tells you how much they bought of it. Nobody ever tells you the weighting, which is oftentimes more important than anything else.
100%. Well, the timing of getting into these things, if I get in something small right away and all of a sudden just boom, it ricochets off my area, if I don't hit, if I'm too far away from like a stop area now, then I just got to let the small area go. But it's like the waiting is that is the most difficult part. That's why I scale, because if I like an area, I put a tester out there, a feeler. I put on a quarter of my position, a third of my position, and let the market action prove to me that my idea is right. People that trade a single contract size every single time are always held strictly by their strategy. They're not held by the reaction to the strategy. And that's why I don't do that. That's why I'm never all in or I'm never all in at once, ever. I mean, I wouldn't say ever, but it's a very rare occurrence. And if it would never be all one click, it would be multiple clicks very quickly in an area, because the reaction would be happening at the same time. And you're right, Michael. I mean, that's it's just one of those things where you have to have experience to know that, because you've been through those moments where you get in and you're just going, oh man, and you just feel it taking a toll on the body. And it's like, look, I can do this a better way. Well, I can tell you this. It goes back to kind of where we started right today, Michael. I think that the ease of access, it creates volatility, and it creates a lot more newer, inexperienced traders chasing things. And I think that it definitely is a factor. I remember a time, when we were in the pit, and I remember when they introduced the E-mini S&P, as everybody was like, oh, geez, what do you need that for, right? And everyone in the pit thought they were the center of the universe. And a lot of them talked about that because all of the flow came into one place. And once again, you had to actually get to that point, or to some level of sophistication, to be able to actually come in there and put an order in. So order flow was really a lot more. There was education or educated guesses behind it, right? I mean, nobody ever truly knows, but the people that were getting to that point were making that. Nowadays, you have so many different access points that there's just it's impossible to know. I think flow comes from so many different places that it's the FOMO is just it's at all-time highs with everything, right? And I think that it definitely plays a role into it, because all of these different factors that we as people, it's hard. I talk about market reactions. It's not easy to interpret it as much, right? Because you're like, sometimes I watch these moves. I mean, I go back to like CPI, right? And it just is like, I'm looking at that move, and I remember hopping on, and I was doing something on my YouTube channel with Develop Your Edge, and we were talking about it. It was like, okay, what did you do this morning on CPI? And I'm like, nothing. I'm like, I'm looking at this move going, how can I trade that? How can I trade that? Nobody wants to sell this next hole. And I know that the tax loss selling is obviously because people are selling it for different reasons, but also they sit back and say, well, is the bottom in? I mean, you have a lot of psychological elements that come into play this time of year. And I think that I know with a lot of my friends, not a lot of my friends have sold stock. These are guys that don't trade at all. They just all invested at all the time. And I have yet to hear in any conversations on the golf course or playing poker that anyone's truly worried about the market. And it kind of brings me to one thing I want to talk about. I'm curious what you guys think, is that Michael, Jason, everybody listening, do you ever remember a bear market where we did not have any form of capitulation? I don't. And we have not had any capitulation yet. And to me, capitulation comes when we least expect it. It's been over anticipated for so long. And I don't know, and I'm not calling for capitulation before the end of the year, but all I'm saying is that we have not had it. And I've just yet to see any sort of market end, a bear market end with that. And not necessarily even capitulation, because I go back to the 9/11 times. I traded during then as well. We had a lot of mini capitulations during that time. But we had years of consolidation. Anybody who traded between 02 and 06 remembers how difficult of a time that was. It was just a grind sideways to up, and we're eventually going to make up a new highs, and it just took such a long time. So a consolidation on the lows could also be in play here, but it's just hard for me to believe that a bear market ends the way that this one would end, because I've seen no signs of anything that I've seen in the past that indicate to me that this is now behind us. Because remember, price will move forward before the news will, right? I mean, we all know that, right? The news will all of a sudden change, and the lows will already be in. As much data driven as we're in, I definitely think that something will happen. Price will get to a point where it just can't go lower anymore. The risk reward has totally shifted, and news will slowly start to change afterwards. That's typically how it is, and I've yet to see any sort of signs of where I feel that that has happened. It's just my 2 cents, and that's just something that's interesting to me.
Yeah, I would add real quick. I mean, so I've despite the whole melt up conditions, right, which I think I've been validated on, but some people still counter it. But regardless, to me, it's very simple, right? This probably doesn't end until the housing bear market ends, and that's still pretty early. I always focus on lumber because lumber is the most telling commodity on credit creation, on expansions, on growth, because of the transmission mechanism to housing. So housing is still just starting to roll over in a big way, and we know the inventory issues will probably make it a more unusual decline to resolve the affordability issues. But I don't see how, in general, you're going to have this kind of end. And honestly, you can't really break inflation unless you break housing anyway. So it kind of makes sense, right, that this will probably resolve itself in some kind of deflation pulse, which scares the shit out of everybody, which creates your capitulation, which then becomes the bottom for everything. But in between now and then, you're going to have these rip your face off rallies. That's why I keep using that point. I keep saying that line: bear market to make fools of bulls and bears. This is why this is so hard for people.
So because you trade options versus me, I trade outrights, right? So I'll trade futures, or I'll just trade, the stock names. I don't trade the options. I think there's a little bit, there's obviously different variables that come into play, because as a non-options trader, but I have traded options, is that sometimes those options, if we start to go in a direction, will not go up as much or as the market does, because there's different, factors in play. So I think on the options side of thing, it would be hard for me to say exactly how I would do that, because, like I said, there's just different factors. When is it expiring? What's the volatility like? And once again, like, I'm not an options trader, but I've traded many of options in my day. So I think from that perspective, it's hard to gauge on how I would do that. But I can say from the perspective of an outright. And so an outright, everybody is just like, if you're long just the SPY, or if you're long the S&P futures or QQQ, whatever, I'm just buying the actual product, right? And that's what I trade. And it goes back to, and what Penny is saying is that she has an idea, and she is now executing based upon that idea, not necessarily based upon the reaction of the market. And the reason is that most people do that is because they say everyone has been drilled into follow your process, follow your strategy. And that's fine. And that's the way it is. I do the same thing. But the other part of it is the actual trader aspect of it is, what does the market think about what your strategy is telling you? And that is, to me, that is the difference between somebody that just follows a process, follows a strategy, and you'll find a lot of people that will be very consistent following their process, but they're really not making any money. And this was me, right? I'm the trader out there who was like, listen, unbelievable. I'm doing everything I'm supposed to do. I come out here, I follow the strategy, exactly what it says. I bought it when I said I was going to. I sold it. I make money, 16 out of 20 days in the month, and I barely made money. This is ridiculous. And the reason is because you're always the same contract size, and you're held by that strategy being so good that literally a few losses, a few mistakes, or one bad choice you make by you going in and losing more than you should, you take 25 to 50% or 100% of that month right out. And it's because you follow the process so disciplined, so well, but in any sort of weak moment, and that weak moment 99% of the time is going to be at a time you shouldn't be aggressive. And that's just most people, right? I mean, I am 100% this person. I did this for years in that exact way. And I just felt like, how am I just bleeding money? It feels like I'm getting better. It feels like everything I'm doing is right. I finally have something that I like, but yet I can't make any more. And the reason is because when you look at the way that the market operates, it's amazing. Sometimes your strategy will work so well and the market reacts to it so well that you have an average to a slightly above average day. But when the market is just shitting all over your idea, you have a far worse day, or you have a string of bad days. You're full risk all the time, and you basically just say, well, it's what I had to do because that's what my strategy says. And if that's the case, I always say to people, if that's the way you want to operate, then just be automated. Don't bother putting in any orders. Because at the end of the day, at least in my experience, the only way I ever got ahead in this business was by taking advantage of the market when the market said, we agree with what you're looking at. And I would just hit it hard. And it's not an easy thing to do, but that's what you have to learn and see what environments that is. And when the market's just shitting on my ideas and it just ripping through my prices, I'm always in small because I'm always in small to start. And it's not perfect, but that's the way I would operate.
Yeah, and I think that's very good suggestions here. Anthony, any just for the audience, and again, everybody, please make sure you follow Anthony, Jason, Penny, everybody here, and thank everybody for joining. But Anthony, any final thoughts or any kind of parting words here? Places people can find you aside from Twitter?
Just that Twitter's the best place. It'll redirect to everything. It's anthonycrudele.com. Also, placeyourtrades.com. I'm hosting morning shows every morning on CME Group's new event contracts. And then I have a whole host of other stuff that I'm doing throughout the week, podcasts and stuff like that. I mentioned Futures Radio Show. That's the podcast I do every week on Wednesday. But really, pretty much everything flows through at Anthony Crudele on Twitter. And I just want to say thank you to everybody for the questions today. And Michael, love your stuff. I can't thank you enough for the invite. I really appreciate it. I appreciate all the work that you're doing out there. And so thank you very much, my friend, and happy Thanksgiving to all of you out there. I hope you all had a wonderful Thanksgiving like I did. And if you don't celebrate it, if you're outside the U.S., I hope all of you are having a wonderful weekend and have a very great holiday season. It's upon us, everybody. It's holidays are here. So thank you all for tuning in.
Thank you, everybody. Cheers. Thank you, Anthony.